Welcome back to the deep dive. Today, we're getting into the weeds a bit, tackling the rules around buying property and getting a mortgage. It sounds complex, maybe a bit dry.
Well, it can seem that way, but honestly, this stuff is really important. It's the framework that's meant to protect you during one of life's biggest financial steps.
Right. So our mission today is to quickly unpack the structure of MCOB, that's the Mortgage Conduct of Business Sourcebook, and also look at some other laws that protect property buyers. We want to show you where your safety net actually is.
Exactly. This isn't just abstract regulation. These rules define what's fair conduct, what information you must be given, and, crucially, what happens if things go wrong. It's about ensuring you get a fair deal. Okay, let's unpack this.
Okay, let's start with MCOB itself. It's this big, separate source book inside the main FCA handbook, isn't it? Looks quite daunting with all those chapters, 15 main ones, plus extras like 2A, 3A.
It is comprehensive, yeah. But Chapter 1 is pretty straightforward. It's mainly there to help firms figure out, which specific rules apply to their business and how MCP fits with the rest of the FCA's general rules. Kind of a starting point.
And then Chapter 2 gets into the real basics of conduct, the general stuff.
That's right. Chapter 2 lays down the fundamental requirement. All communications ads, letters, whatever, must be clear, fair, and definitely not misleading. It's the bedrock.
That covers things like rules on inducements too, I suppose, making sure firms aren't pushing products inappropriately.
Precisely. And building on that, Chapter 2A is really key. This came in with the Mortgage Credit Directive, the MCD.
Ah, yes, the MCD. That added quite a lot, didn't it?
It really did. Chapter 2A brought in specific requirements on things like how staff are paid their remuneration to avoid conflicts of interest. Also, rules on time practices, early repayment conditions, and managing foreign currency loans.
Time practices, that's the classic, you have to buy our insurance to get this mortgage scenario.
Yeah, exactly that. The rules clamp down hard on that kind of pressure. What's interesting is just how detailed 2A gets about how firms need to operate internally to ensure fairness.
Okay, so the foundations are clear communication and fair internal practices. Let's move on to what the borrower actually sees. The advice and selling stage. Chapter 4, right? Disclosure is huge here.
Absolutely huge. Chapter 4 covers the standards for advising and selling. Key things you'll encounter are the initial disclosure document, the IDD, which sets out the firm's services and costs up front.
And it also covers rules on independence and, I guess most importantly, the suitability of the advice itself.
That's the core principle, suitability. If a firm recommends a mortgage, they must be able to show it's suitable for your specific needs and financial situation. If they can't justify that, well, they're breaking the rules.
Then we get into the really specific disclosure documents. People hear about KFIs and the ESIS, chapters 5 and 6, and their A versions.
Right. This is where the MCD added another layer. Before the MCD, or for loans not covered by it, firms give you a key facts illustration, a KFI. It's meant to be a standardized summary.
Okay, the KFI.
But for mortgages regulated under the MCD, Chapter 5A requires firms to provide a European Standardized Information Sheet, or ESIS, before you apply.
So, two different documents depending on the type of mortgage? KFI or ESIS? That sounds potentially confusing.
It can seem that way, yeah. But MCOB dictates the timing and the required content for both. The goal is the same. You get clear, standardized information before you commit. The ESIS was really brought in to help people compare loans across different EU countries, though obviously things have changed a bit there.
Right. And this is all pre-application, what happens at the offer stage. That's chapter 6 and 6A.
Yes. Once you're actually approved, the firm has to give you the formal, binding mortgage offer. And critically, MCOB mandates a reflection period.
A cooling off period, basically.
Exactly. You need time to read it, think about it, get advice if you need to, without being rushed into signing on the dotted line.
Okay, this is fascinating because the rules don't just stop once you've signed. MCOB follows you through the whole life of the mortgage, doesn't it? Chapter 7, post-sale stuff.
That's a really important part. MCOB isn't just about the sale. Chapter 7 provides ongoing protection. It mandates things like clear annual statements showing your balance, interest paid, the works.
And it also covers changes later on, like if you wanted to borrow more money, a further advance?
Yes, any post-sale contract variations fall under these rules. They can't just change significant terms years down the line without following proper procedures and disclosures. It ensures continued transparency.
Let's switch gears a bit. Mortgages aren't one size fits all. What about specialized areas, like equity release?
Good point. MCOB recognizes that. Chapters 8 and 9 deal specifically with equity release, so lifetime mortgages and home reversion plans. These have their own tailored regime for advice and selling.
Because the risks and the client group are different.
Precisely. Often older, potentially more vulnerable customers. The rules are stricter. For instance, a lifetime mortgage. The typical arrangement is that the loan is only repaid when the borrower dies or moves into long-term care. The advice needs to be incredibly thorough for that kind of commitment.
And MCOB is flexible enough for other needs too, like Islamic home finance.
Yes, it has to be. Chapter 15 covers Sharia-compliant home finance. These use structures like sale and leaseback, for example, to avoid charging interest, which is forbidden under Islamic law. The framework acknowledges these different models while ensuring the core principles, disclosure, fairness, still apply.
Okay, now for the tough part. What happens when borrowers get into difficulty? Chapters 12 and 13 seem crucial here.
They really are. This is the safety net in action. Chapter 13 deals with handling arrears and possessions. Firms must treat borrowers in difficulty fairly and provide clear information.
And what about charges? Arrears charges, early repayment charges. Chapter 12.
Right. The rules are very clear. Any charges in these key areas must be reasonable. And crucially, they can only reflect the lender's actual costs incurred because of the arrears or early repayment. They can't be used as a penalty or to make excessive profit.
So no punitive charges allowed, just cost recovery.
That's the principle. And underpinning all of this is Chapter 11, Responsible Lending. This goes back to the start of the process.
Affordability checks.
Exactly. Lenders have a duty to properly assess your ability to repay the mortgage over its term, checking creditworthiness, verifying income, assessing affordability before they even grant the loan. And if they reject you based on affordability, they need to explain why.
So MCOB creates this regulatory bubble around the mortgage product itself, from the very first advert right through to potential problems years later. But buying a house involves more than just the lender. What about estate agents? Marketing.
That's where we look beyond MCOB. There are two other key pieces of legislation we need to touch on. First, let's clarify something about the Consumer Credit Acts, the ones from 1974 and 2006.
Okay, what about them? They cover loans, right?
They do, but mostly unsecured loans, credit cards, hire purchase, that sort of thing. The crucial point here is that regulated mortgage contracts and MCD mortgage contracts, the ones covered by MCOB, are specifically exempt from most of the Consumer Credit Act rules.
So MCB takes precedence for mortgages to avoid overlap.
Exactly. It's specialized regulation for a specialized product. So the other key piece of law protecting you in the property transaction itself, especially around marketing and selling practices, is the Consumer Protection Amendment Regulations 2014.
The 2014 regulations, okay, what do they do? Who do they apply to?
They apply to professionals involved in the transaction. Crucially, this includes estate agents and property developers. They replace some older, less effective rules and aim to give consumers much clearer rights.
And their main aim is?
At its heart, there's a general ban on unfair commercial practices. Simple idea, but powerful.
How is unfair defined, though? That sounds a bit vague.
Well, the key test is whether a practice misleads or is aggressive, and whether it's likely to distort the economic behavior of the average consumer. It's about protecting typical buyers from being tricked or pressured.
The average consumer test. So it's not about protecting, say, a financial expert, but the person on the street.
Precisely. The regulations even have a blacklist of practices that are considered unfair in all circumstances, no questions asked.
Like what kind of practices?
Things like falsely claiming membership of a trade body or bait advertising a property that isn't really available to lure you in. But the main categories are misleading actions, misleading omissions, and aggressive practices.
Okay, let's break that down for estate agents. What's a misleading omission?
That would be failing to disclose important information that the average buyer would need to make an informed decision. For example, not telling you about a major known defect like subsidence, or perhaps significant planning permission nearby that could affect the property, or even something like unusual lease terms.
And misleading information.
That could be anything from, say, significantly exaggerating room sizes in the marketing details, to maybe implying an offer has been made when it hasn't to create false urgency.
What about aggressive practices?
That involves harassment, coercion, or undue influence. So maybe repeatedly calling you, putting you under intense pressure to make an offer quickly, or perhaps suggesting your offer won't be put forward unless you use the agent's recommended mortgage broker or solicitor.
Right, that pressure tactic again. So these 2014 rules give you, the consumer, the right to redress if an agent acts like this.
Yes, absolutely. If you suffer loss because of a misleading or aggressive practice covered by these regulations, you potentially have the right to unwind the contract or get a discount. It really puts the onus on professionals to act decently. It raises that interesting question, though. How much research is an average consumer expected to do for themselves versus what must be disclosed?
That's a tricky balance. Okay, so let's pull this all together. We've got MCOB, which tightly regulates the mortgage loan itself, the advice, the disclosure, the handling of problems.
Yep. MCOB covers the product lifecycle.
And then we have the Consumer Protection Regulations from 2014, which police the actual selling and marketing practices, particularly from people like estate agents, ensuring they don't mislead or pressure you during the transaction stage.
Exactly. The two work together. MCOB for the loan, the 2014 regs for the sale process. It's designed to be comprehensive coverage.
And the system tries to catch edge cases, too. You mentioned something about an accidental landlord.
Ah, yes. That's a good example of how the Mortgage Credit Directive, and therefore MCOB, extends protection. Imagine someone, let's call him Anjay, inherits a property. He doesn't plan to live there, maybe he wants to rent it out, and he takes out a mortgage on it.
Okay, so it's technically a buy-to-let mortgage.
Yes, but because he's become a landlord sort of accidentally rather than as a business activity, it could be classed as a consumer buy-to-let under the MCD rules. And if it is, then many of the MCOB protections apply to him, treating him much like a standard residential borrower.
Interesting. So even in slightly unusual situations, the protective rules can still kick in. That's the idea. The system aims to provide consistent protection where the borrower isn't acting purely as a professional property investor.
Right. That makes sense. It shows the depth there. So thinking about all this for you, our listener, next time you're looking at mortgage paperwork, like that ESIS or KFI, or you're reading an estate agent's property description, maybe think about the rules working behind the scenes. Which part of this structure, MCOB's rules on advice suitability, the limits on charges if things get tough, or the 2014 regulations stopping misleading marketing, feels most vital for your own peace of mind when navigating the property market? Something to consider. Thanks for joining us for this deep dive.